Hey everyone, happy Groundhog Day. It's Thursday, February 2nd, about 11:45 on the West Coast, and it's time for another market update. Just for your information, it sounds like Phil the Groundhog did see a shadow, so we're on the hook for another 6 weeks of winter, unfortunately. But it was a busy week in the market, so I want to get right into it. Headlined by yesterday's Fed meeting. But first, going back to last Friday, we got PCE inflation data. So the headline came down 0.5% to 5%, and the core, which strips out energy and food, and which the Fed likes to look at the closest, was down about 0.3% to 4.4%, both in line with expectations. And then we can see it's down from its peak in June of 2022 pretty steeply. So we still need to come down further, but it's good to see inflation coming down because we know that as inflation comes down, mortgage rates will come down with it. Second thing we got December pending home sales are up 2.5%, still down 3% or 33% year over year. They did make a positive revision to November to make those numbers not as bad as they were, but it's good to see an uptick comparatively. It's better than a negative number, so good to see them. Hopefully, it translates to a strong spring season. And then we got Case-Shiller home price index for November, which is considered the gold standard for appreciation across the country. It's down 0.6% month over month. It's up 7.7% year over year. And then it's down from its peak. So the peak in March, it was appreciating about 20.4%. And now we're at 7.7%. So that doesn't mean your homes are down 13%. That means they're just not appreciating as fast. They're only down 3.6% from that peak nationwide. Obviously, that's going to be regional, some areas more than others, but a far cry from 20% down. So that's good to see that it's really not that far off that March 2022 peak. And then the FHFA was down about, which is very similar, but strips out jumbo loans and cash loans. So it ends up being a lot, conforming loans. So, usually lower price homes compared to Case-Shiller. That's down 0.1% only. It's up 8.2% year over year and only down 1.2% from the peak. So the reason we could say that, we've seen anecdotally that higher price homes may be bigger price cuts. So that would probably be the difference in the data. And we got a lot of jobs data over the last couple of days. So we got initial jobs claims. They were for unemployment. They were expected to be about 200,000. They came in at 183. So pretty strong labor going on right now. The ADP though showed 106,000 job creations when they expected 175K. So runs contrary to the last one. JOLTS, which is the jobs opening report, came in at 11 million, was expected to only be 10.25 million job openings across the country. But keep in mind that JOLTS report grabs jobs that have multiple state listings. So if you were posting a job and you were willing to hire someone in 50 different states to work remotely, it's going to pick up 50 different job openings. So a little inflated. The Challenger job cut, which measures layoffs, came in at 102,000 for the month, which is the highest since September 2020. So a lot of different contradicting jobs things, something to keep a really close eye on because we know the Fed is keeping a close eye on it and what they may do in the future. So tomorrow we're going to get a big BLS jobs report, and that could be a market mover. So depending on how that comes out, if it comes out, unemployment's supposed to go from 3.5 to 3.6. If it stays flat or comes down, that might be bad for the markets. Whereas if it goes up as expected or more, that would be more of a positive for the bond markets and mortgage rates. And then the big thing we got this week was the Fed meeting. So they came in at their 25 BIP hike as expected. And that raises the range to a 4.5 to 4.75, and it's gone up about 4.5% since March of 2022, which is a big increase in a year. So then, we get their increase, then we get a statement, and then we also get the press conference. So the statement was a little bit more hawkish. The press conference was a little bit softer, though, which was good to see. So basically they said, they see ongoing increases as appropriate. We're looking like we're going to have about two more increases at about 25 bips each. The next meeting is going to be March 22nd, so that would be when the next one happens. And that would, land us at about 5 to 5.25% Fed fund rates. And that matches up what they had predicted in December. So it looks like that's where we're headed. And then in the press conference, Jerome Powell did recognize that inflation has eased, but he still says it remains elevated in certain aspects. But like I said, it was a softer tone. The markets did react positively to the press conference. So we need to keep a real close eye on core services excluding shelter. It seems like that's the one the Fed's keeping their close eye on, and it was pretty flat this last report for PCE. So got to keep a close eye on that because that might dictate where they go going forward. But as of now, it looks like maybe two more hikes, the next two meetings of 25 bips, and then not necessarily a cut to the rate, but they'll stop. That's the hope at least. And like I said, the next meeting's coming up March 22nd with new forecasts. So where did that land us after all of this happened in the week? Last week we were at about a 6.18% was the average conventional 30-year rate, I believe. And remember, that's a nationwide survey of lenders. It's not, not everybody doing conventional loans going to get that. It tends to be, 740 plus credit scores, 20% down, things like that. But we were at 6.18, and today we're at 5.99. So we finally broke through that 6% mark, barely. Tomorrow it might be back above that, depending on how today goes. It's been an up and down day, but it's good to see. It's good to see we finally broke through that number, and hopefully it continues that downward trend. But it's great to see. And like I said, with different access to different programs, if you're at let's say you buy down the long-term rate to 5.75, and then do one of these 2-1 buy downs that people talk about. That's a great deal. Your 5.75, the first year will be 3.75, the second year would be 4.75, and then it would finally go to that 5.75. But that's what you would have anyways if you just did a normal conventional. That does require generally a seller credit, but it's a really good option for people to keep their payments down the first couple of years, and then ideally, as rates come down and the markets change, then they refi before it does go up to that high point. But even if it did, it would still be what they'd be getting anyway. So great deal. So that's all I got for you guys today. If you guys need anything at all, please do not hesitate to reach out. Let's hope for some more positive momentum as the week goes on, and keep an eye on that jobs report tomorrow. Have a great day, everybody.